Hello and welcome to this session. In this session, we will discuss meaning of mutual fund and learn to calculate price and current yield of bonds. Let us start by the definition of mutual fund. Mutual fund is an investment scheme that pools savings of investors who share a common financial goal. The money collected is invested in financial market instruments such as shares, bonds, debentures, securities, etc. The income earned through these investments is shared by its unit holders in proportion to the number of units owned by them. As there is no fixed amount of capital in the fund, so it is known as open-ended fund. These funds are managed by the investment companies. Just like stock prices, mutual fund share prices fluctuate up and down according to the market. Now let us discuss bonds. Bonds are long-term debt securities that are issued by corporations and government entities. When companies or governments need to borrow money, they may issue a bond. People who buy the bond are lending their money and will be paid interest on it. When an investor buys bonds from the government or corporation, it means they are lending money to the government or corporation. Bond is normally an interest-only loan. It means the borrower, that is the company or government, will only pay the interest every period, usually annually, but none of the principal will be repaid until the end of the loan. For example, if you buy a bond of $1,000 at an interest of 10% for 3 years, then the issuing authority will give you an interest of 10% on $1,000. That is $100 per year. And at the end of third year, you will receive back your $1,000. So, in the first year you get $100, in the second year you get $100, and in the third year you get $100 interest plus $1,000. Now let us discuss some of the terms related to bonds. First, let us discuss face value or par value. It is the amount which the bond holder receives at maturity. $1,000 par value bond will be worth $1,000 at maturity. Next is coupon rate. The coupon rate or rate of interest, which is generally fixed, determines the periodic coupon or interest payments. It is expressed as a percentage of bond's face value. Now let us discuss coupon payments. The coupon payments represent the periodic interest payments from the bond issuer to the bond holder. The annual coupon payment is calculated by multiplying the coupon rate by the bond's face value. For example, coupon rate percent is 5% on face value, where face value is $1,000, then coupon payment is equal to 5% of $1,000, which is equal to 5 upon 100 into 1000, which is equal to $50. So, bondholder will get an interest of $50 per year. Note that coupon payment can also be done semi-annually, that is, in a period of 6 months. For example, if coupon payment is equal to $50 per year, then its semi-annual payment will be $25 paid twice annually. That is, one payment of $25 and after 6 months another payment of $25. Now let us see what is maturity date. The maturity date represents the date on which the bond matures, that is, the date on which the face value is repaid. The last coupon payment is also paid on the maturity date. Now we shall discuss how to find value or current price of bond. The present value of bond is equal to present value of interest payments plus the present value of principal payment. Present value of interest payments is equal to C into 1 minus 1 plus R the whole raised to power minus N upon R, where C is equal to coupon payment. R is equal to market interest rate or discount rate. And N is equal to number of payments. And present value of principal payments is equal to FV upon 1 plus R the whole raised to power N, where FV is equal to face value of the bond R is equal to market rate or rate of return. and N is equal to number of payments. So present value of the bond is equal to C into 1 minus 1 plus R the whole raised to power minus N upon R plus FV upon 1 plus R the whole raised to power N. Let us consider one example. A bond that matures in 12 years has a par value of $1,000, an annual coupon payment of $100 and market interest rate of 8%. What is its price? So here we are given a bond that matures in 12 years. Since there is an annual coupon payment, so number of interest payments is equal to 12. So N is equal to 12. Par value is equal to $1,000. This implies FV is equal to 1000. Coupon payment is equal to $100. This implies C is equal to 100. Market interest rate is equal to 8%. This implies R is equal to 8%, which is equal to 8 upon 100, that is equal to 0.08. We have to find its price, that is the present value. We know present value of the bond is equal to C into 1 minus 1 plus R the whole raised to power minus N upon R plus FV upon 1 plus R raised to power N. Putting the values in the formula, this is equal to 100 into 1 minus 1 plus 0.08 the whole raised to power minus 12 upon 0.08 plus 1000 upon 1 plus 0.08 raised to power 12. This is equal to 100 into 1 minus 1.08 raised to power minus 12 upon 0.08 plus 1000 upon 1.08 raised to power 12. This will be equal to 100 into 1 minus 1 upon 1.08 the whole raised to power 12 upon 0.08 plus 1000 upon 2.52. That is equal to 100 into 1 minus 1 upon 2.52 the whole upon 0.08 plus 396.82. This value is calculated by using a calculator. Now again, this will be equal to 100 into 1 minus 0.3968 the whole upon 0.08 plus 396.82. Again, by using the calculator, this is equal to 754 plus 396.82, which is equal to 1150.82. So, price of the bond is equal to $1,150.82. Note that if coupon payments are made semi-annually, the present value of the bond is equal to C by 2 into 1 minus 1 plus R by 2 the whole raised to power minus 2n, the whole upon R by 2 plus FV upon 1 plus R by 2 the whole raised to power 2n. Now let us discuss current yield. The current yield considers the current market price of the bond instead of its face value. It represents the return an investor would expect if he or she purchased the bond and held it for a year. The formula for calculating current yield is given by annual interest payment upon current price of bond. To convert it into percentage, we multiply it by 100. For example, annual interest payment is $100. Current price is $1,150.82. Then current yield is equal to 100 upon 1150.82, which is equal to 0.0868. That is equal to 8.68%. It is important to note that bonds may sell for less or more than par value. The price of bonds moves in opposite directions of interest rates. If rates go up, price of the bonds decrease, and if rates go down, price of the bonds increase. Now let us discuss commission charge on bonds. Older bonds are bought and sold in secondary market through brokers. A person buying or selling the bond has to pay brokerage charge, that is, commission to the broker. Thus, when bonds are bought and sold in secondary market, a brokerage charge is commonly added to the price of each bond. There are no fixed commission charges, but it may vary from 1% to 5% of bonds value. So, in this session, we have discussed mutual fund and learned how to calculate price and current yield of bonds. This completes our session. Hope you enjoyed this session.